So we are starting with return today.
Okay.
See, return is nothing but the reward which an investor gets from his investment. Okay, it is nothing but the reward or income what an investor receives from an investment. So first we are speaking about annual rate of return. What is annual rate of return? See, when you invest your money for one full year, you will be getting some returns out of that. Let's say you have invested $100,000 and at the end of the year you got $10,000. So what is your annual rate of return?
10%.
10%. That's it. Okay.
Hmm.
It is annualized. That the thing is,
Okay.
it is per annum. So please go for this question and calculate.
10,000 for 1 on 500 in return. 2.5. 5%.
Very simple. Like they have given
Yeah.
that you have invested $10,000 and you're making $500 is the return, 5%. And if it
5%.
is like for if you take if they give you like semi-annually the returns or coupons, interest, whatever return you get semi-annually. So you get 250 in 6 months. So in 1 year it becomes 500. So 5% still.
Okay.
And suppose then go for the next scenario. So he invested $10,000 for 3 months, then withdraws $4,000, leaves 6,000 on deposit for another 3 months. Okay. At the end of the 6 month, the investor withdraws the remaining 6,000 along with income received 200. What is the investor's return? See, for what we'll do is we'll try to see the average balance. What we'll see?
Average balance.
Average balance of investment over the term of 6 months. So first he invested 10,000 for 3 months, and then next he has invested 6,000 for next 3 months. That is in the span of 6 months. So average balance is 8,000, correct?
Okay.
And what returns he has got? The amount of income received for those 6 months was 200, and that is equal to 400 when it is annualized, when we multiply by it, correct? Because things are clearly given. So we are seeing annualized returns here. So 400 divided by 8,000 is again 5%. Okay.
Okay.
What is the relationship between risk and return? There is a trade-off between risk and return. The more the risk you take, the more the returns you should expect. Okay, because since you are taking higher risk, you want to be compensated with more returns since you are taking a higher risk. Otherwise, if you are not taking higher risk, you are like satisfied with less returns as well. Am I right?
Mm-hmm.
If you are not taking higher risk, you are satisfied with less returns as well. But since you are taking higher risk, you want higher returns because you want to get compensated for taking that additional amount of risk. Okay, that is the point here. And next thing is, just a second. Now, so if investors must choose between two assets, see, there are three types of investors here. One is like risk averse, one is risk seeker, and one is risk neutral. Risk averse is the one who does not want to take higher amount of risk. That means for less risk, he wants more returns. Okay, he wants to take very less risk, but he wants more returns. Risk seeker is the ones who take high risk and they expect high returns because they're taking higher risk. Risk neutral are someone who is okay with high risk, less risk. Okay, they they are like indifferent to either higher risk or lower risk. That means everything is okay for them. It doesn't matter for them higher risk or lower risk. Fine. So they are okay with
Okay.
any kind of risk and any kind of returns. Here we are going to see some of the investments with respect to risk and the returns, what they can give you. We are going to see that in an order. So US Treasury bonds happens to be the least risky investment option that can be termed as a risk-free investment, because United States government has never defaulted till now since their independence, when this treasury bonds came into picture, because the America's government also wants funds to develop their infrastructure and for their needs. So they borrow from public and they definitely have paid their interests always on time and never have defaulted. So this can be termed as a risk-free
Mm-hmm.
investment. All the black money in the world which goes to Swiss bank, again Swiss bank also buys the treasury bonds, and
Okay.
they do that is nothing but they consider this as the most secure investment. Okay. First mortgage bond. These are secured bonds whereby the mortgage, the property has been submitted, or kind of the property has been kept as collateral with the bank. Okay, since the property has been kept as collateral with the bank, or it has a backup of the bonds have the backup of the assets, those are called asset backed securities. And even there is a default, then what? The assets will be sold and the money will be returned back. Am I right?
Yeah.
Or the money can be claimed by selling the assets. Then comes second mortgage or subordinate debentures. These are the bonds that have collateral behind them, but the claim of these investors is behind the claim of other investors. That means these are the second mortgage bonds or subordinated debentures. These are also having some collateral, but they like they have the second claim. Okay. Hello.
Like, can you explain, sir?
See the first
Collateral
claim.
means what?
No problem. We can discuss. Like I'll give you a real time example of such kind of bonds. We'll see what kind of bonds in India, because I'm not investing in bonds these days.
Okay.
Just a second. Subordinated debentures. See, subordinated debenture is an unsecured loan or bond that ranks below other more senior loans or securities with respect to claims on assets or earnings. Subordinated debentures are thus known as junior securities. So, normal debenture and subordinate debenture difference is, debenture is referred to as an unsecured bond, first of all. Subordinated debenture, as the name would suggest, is an unsecured bond that possesses a claim on company's assets and income only after all the secured bonds and debentures have been fulfilled. Okay.
Okay.
The point here is, see, the first mortgage bonds have the backup of the asset collateral. Okay. But I don't know what kind of definition this people have. Just a second, Suma. I'm getting a call. Just a second. Hello.
Yeah, sir.
Yeah, see, subordinated debentures, the version what these people are giving is somewhat controversial. Okay.
Okay.
Actually, subordinated debentures are nothing but the debentures which are unsecured debentures. Actually, they do not have any security as a collateral. But these guys are saying that the bonds have collateral behind them. What is the collateral? This version is a wrong version because you see a number of data. This kind of notion is not there.
Uh-huh.
It's a subordinated debenture itself is unsecured bond. Okay,
Right.
but I don't know like why these people have given this thing. They don't have actually any collateral. Generally what subordinated debenture is, it's a unsecured bond which doesn't have security, and the first mortgage bonds are the ones which are secured bonds. So now you tell
Okay.
me, whenever the repayment comes, the company has to repay both of them, but who is making the claim first?
The
the
first one.
the ones who have given their asset as collateral, am I right? So they
Right.
are the ones who are the ones who have to be ranked first. Okay,
Right.
and then these people will be given the next priority. Why? Because those people are like pressurizing company to sell the assets and give the money back. Understood?
Yeah.
That's what is the thing here. That's the reason why these are called subordinate debentures, because they can claim only after the claim of the first mortgage bonds. But I'm
Okay.
really doubtful about the statement what they are giving. It's a controversial statement. Generally, if you want, I can send you a number of links, or you can Google out. You will not see any kind of subordinate debentures with any collateral actually.
Okay.
Income bonds are those bonds which pay interest to bondholder only if the income of the company exceeds a certain level. Suppose company has promised that they'll give interest, but the income or the profit should reach more than $1 million. So then they'll give more.
Okay.
Preferred stock is nothing but the shares which have got the preferential rights. That means they will be getting the dividend before the equity shareholders, and they'll be getting fixed dividends. Okay, and their shares are also redeemable. That means money has to be given back to them. Then comes the
Okay.
convertible preferred stock, which can be converted into equity, and then comes the common stock, the most riskiest one. So the least risky, next list, next list, next list, next list, next list, highest risky. Okay.
Okay.
Yeah. Shall we move forward?
Yeah. Yeah.
Now next comes the CAPM model. See what does this CAPM model tells? Please try to understand. I'll ask you some questions. See, you want to invest in a company's stock, okay? And the
Okay.
company is offering you, let's say, 5% returns. Now, the first and
Okay.
foremost question what I put to you is, are you satisfied with this 5%? So the answer from your side would be, yes, I'm satisfied. Can be yes, can be no even. If you compare this returns with some other kind of returns what you are getting from the
Uh-huh.
market. For example,
Yeah.
yeah, if I take a bank, and this is XYZ company, and bank is giving you somewhere around 5% returns, and this XYZ company is giving you 5% returns, which one will you prefer?
The XYZ company is giving me
5% returns. Which one would you opt?
one is 5% and one is for
5%, both. Bank is giving you
5%.
5%, XYZ is giving you 5%. Which one will you prefer?
Go with the bank 5%.
Why?
It would be secured.
Yeah, because bank, the money which you keep in bank is very secured investment. It's like, there's no risk at all what you have in this. Okay, so 5% is something whereby you have zero risk and 5% return. So anyone would go for this. So we'll say yes and no to this. Okay, point number one.
Right.
Just a second, Suman. Yeah. Now next again, this is the stock market. Thank you. It's giving 7% and XYZ Corporation is also giving 7%. Which one will you prefer?
One is stock market, one is corporation.
Yeah. From the risk perspective, which one will be more preferable?
Then the XYZ.
No, XYZ is very risky one, na? Because it's only one
Okay.
company. It's only one company. But stock market is a combination of 30 companies. So if you
Right.
put your money by buying the index stock, your money would be allocated into all those company stocks, and if one or two are not performing, still the others will perform. So you'll be getting more secure returns here.
Okay.
Because it is a diversified way of investing and this is non-diversified way of investing. It's very risky. That's why I say now, all don't put all the eggs in one basket. Otherwise,
Right.
it can get damaged here. There's if the money has been divided, we can say the eggs have been divided into various baskets. If one or two falls, doesn't make it, it doesn't matter. Okay. So we will
Right.
prefer this and we'll say no to this. Now the next question for you is, what should be the expected return from this? To get the answer for that question, we have a formula of CAPM. Okay.
What's the formula?
Is
What's the full form? CAPM?
capital asset pricing model.
Capital asset pricing model. Okay.
So expected return is equal to risk-free rate plus beta into return from the market minus risk-free rate. Just make a note of this. We'll discuss about this.
Expected rate. Okay.
Now, so here all the things are very simply understood. Risk-free rate is 5%. That is the bank.
Yeah.
Market return is 7%. And again risk-free rate is 5%. Only the thing what we do not know is beta.
Beta.
So beta is nothing but it is an indicator of risk. What is that?
Indicator of
Risk.
risk. Okay.
It shows you the risk what you have in the security with respect to risk in the market. Market risk is always equal to 1. Beta is equal to 1. That means that is the 100% risk what you have. Okay.
Right.
That is called systematic risk, which cannot be further minimized. Why? Because whatever you wanted, you have entirely put your money in a diversified portfolio. Okay, that is, you have put your money in the market and you cannot further diversify that. Am I right?
That's right.
If you are investing in one single company, you have scope of diversification by taking more 5 or 6 company stock. But you already have put your money in Bombay Stock Exchange or Nifty, where there are 30 and 50 companies. You cannot further diversify because more members cannot be added to that Nifty or that index. Correct?
True.
So the risk whatever you have is the market risk, because when market will crash, every stock will suffer. But if one company goes into losses, other companies will not face that much of issue or problem. Is it right?
Yeah.
One company cannot have an impact on market, but the entire all the companies will be impacted the market if there's a crash in the market. Okay, if there's a market crash.
Market crash. True.
Now, next point. So now comes the beta. So let's say the company you are taking na XYZ Corporation. The beta of that XYZ Corporation is 1.4. Let's say. What is that?
1.4.
The meaning is 1.4 divided by 1. That means the risk of investing in that XYZ Corporation is what with respect to investing in market. So
Okay.
XYZ Corporation is 40 times more riskier than market, correct?
Right.
So we'll put 1.4 here. 0. So please calculate and tell me what's the answer.
Oh, I don't have the calculator. I'm not using the calculator in front of me.
Not using.
Yeah.
Okay. %7.8 is my return. Okay.
Okay. This is like 0.05 plus 1.4
Into 0.02.
into 0.02.
Yeah.
Okay.
Now I will give you some task, but you have to use your calculator. I am giving you the same data, but beta I am changing to 0.8 and I am changing to 1.6. You have to put this two and find out and tell me the returns fast.
How to wait, sir? Need to get the calculator.
Yeah, yeah, okay.
One 1.6 and 0.8, right?
Yeah.
1.6 is the beta.
Sorry.
1.6 is the beta.
Yeah, yeah, that's a beta. Yes, yes, yes.
And 0.8 is the
0.
this 0.8 is what?
0. Beta. That's a beta.
Both are beta.
Yeah. One time you take 0.8. One time you take 1.6.
1.6 plus 1.4. Okay. One is 6, I believe. 6. 0. Can you calculate, sir?
I shall calculate.
You said beta would be.
Yeah. Sorry.
I got confused.
Okay.
0.85 minus 0.2. 17. This is can you just explain me the calculation? 0.05 plus 0.08, right?
0.8, not 0.08. It's just 0.8.
0.05 plus 0.8, 1.3. And you have done 1.3 into 0.02. What you have done? 26 hours. So have you done into or what you have done? 66
Into 0.07 minus 0.05 is 0.02. 0.02 into 0.8, whatever you get, plus 0.05.
0.02. Okay. Okay.
After that, whatever I got, I multiplied with 100.
Okay.
So now here I got 8.2%. When my beta is 1.6, my returns are 8 point, expected return is 8.2%. When my so with 1.6 beta 8.2%, with 0.8 beta 6.6%, with 1.4 beta my return was
70.
7.8%.
7.8. The beta will change.
Gone. So what do you notice? When the risk is less, the return is less. When the risk is increasing, return is increasing. And when the risk
Right.
is most, the return is the highest, correct?
Yeah.
This is what is CAPM model all about.
Okay.
As the beta value increases, because the systematic risk is increasing, the returns will also increase. Okay.
Increase.
There are two types of risk here: systematic and unsystematic. Systematic is the market risk, and the unsystematic risk is the risk associated with a company. Only a company. Okay, one single company, and that can be reduced through diversification. But if you have invested your money in a stock market or some portfolio you have put your money in mutual funds, further diversification you cannot do, correct?
Right.
What happens is when the so that is called systematic risk, which cannot be minimized. Only the risk which can be minimized is unsystematic risk, correct?
Unsystematic. Yeah.
What is the concept? You can do this question right now.
Return 0.8, invest expected rate of return 6.5, and the risk rate is 0.5. Risk 0.05, beta is given 0.8. This 0.005 has been calculated twice, sir.
Calculated? No, this is risk-free rate, na? See, assume company X stock has a beta of this. Expected market rate of return is 6.5. That is RM. Risk-free rate is 0.5. That is RF. Beta is 0.8. Beta into RM minus RF. And risk-free rate is 0.5%. RF. So this, sorry, RF plus. So this entire formula gives you the expected return, na? When you calculate.
Okay.
That's what.
Okay, sir.
Okay. So here you can see as the beta is increasing, the returns are also increasing,
Increasing.
and we can put that in a security market line. This y-axis shows the systematic risk. Which is nothing but beta. So these are all betas. Okay. And these are the returns. Fine. So as you
Okay.
see, the risk is increasing from 0 to 0.5. This is called the risk-free rate. That means whatever the risk you take, this will not change. Why? Because that means whatever the case or condition is, this particular return risk-free rate is constant. Am I right?
Right.
That means the treasury bond will give you only that 0.5% returns for whatever the case may be. Okay. So risk-free rate is always constant. Risk-free rate is always constant because there is no risk, but they are giving you some fixed returns. Am I right?
That's right.
That's the reason why it is starting from 0. Now, but what happens is, as the risk is going on increasing, as the beta has gone from 0 to 0.5, your return has gone from 0.5 to 2.25, correct?
Yes.
And then as the risk is increasing from this, the return is this. From here to here, return is this. So you can see that as the risk is increasing, the returns are increasing. And the difference between risk-free rate, which is this, okay, and this is market risk. All are market risk, correct? This is called market risk, systematic risk. The difference between, suppose you are into this point here, let's say 8%. What is that?
8%.
So difference between 8% and 0.5 is called premium. What is that called?
Premium.
So I can write it here. Expected return is equal to risk-free rate plus beta into risk market return minus risk-free rate. The difference here is called premium. What's it called?
Premium.
Why premium? Because you are taking additional risk. You are getting additional returns. That is nothing but the premium you are getting. Am I right?
Okay.
That is compensating you because you are taking a higher risk. You understood?
Yeah.
And since this premium is multiplied with this factor called beta, it is called risk premium. What it is called? What it is called?
Risk premium.
So the difference between this 8 and this will be called risk premium. Difference between this and this will be called risk premium. See, this is constant, but always the differences are created. The highest difference is seen here. The next highest difference is seen here, but all are called risk premiums, correct? Why? Because
Right.
at this risk, the premium was this. At this risk, the premium was this difference. At this risk, the premium was this entire area. Now at this risk, the premium is this entire area, correct?
Right.
What is all about this, and then we can go for the next topic. Should we continue?
If you want, you can continue, sir.
Why? Because it's 2:10 already. That's what I'm saying.
Today work from home.
Okay, work from home. Okay. Because I have a class right now in 10 minutes. So
Okay. No worries, then you can continue.
yeah, we can take up next class from here. Okay.
Okay, ठीक है.
Next class will be the final class for risk and return, because you can see here portfolio theory is going to start.
ठीक है.
Next topic is going to start. This is the last topic. Risk and return will be done in the next class. Okay. And I'll
Okay.
immediately jump into.
When can we start some? How many topics are over so far in part 2, sir?
No,
Can you
see,
check?
I will like first finish this long term, then
Okay.
budgeting and this together will take one week to 10 days session. Why? Because it's a very big chapter. So let me go through all the things. I think 1 week or 10 days it will take for me to finish this completely. Long term financial management.
अच्छा ठीक है.
Okay, then you'll be having only CVP analysis and pricing. Those two then done. Part 2.
Okay, okay, ठीक है sir.
Okay, Suman. Then we'll connect in the next class. Thank you.
Thank you.